Hello, welcome to Converging Dialogues. This is Xavier Bonilla. On this episode, I am very happy to bring the conversation I had with John Cochrane. John is a senior fellow at the Hoover Institution at Stanford University. He has a bachelor's degree in physics from MIT and a Ph.D. in economics from the University of California at Berkeley. He has taught in many places before coming to the Hoover Institution, such as at the University of Chicago and also at UCLA. And he is currently a senior fellow of the Stanford Institute for Economic Policy and Research. He's been a past president and fellow of the American Finance Association. He's also been the editor of several journals, received many awards within finance and economics. He is the author of numerous books, including the most recent, Crisis Cycle, Challenges, Evolution, and Future of the Euro. That's with his two co-authors, and that is the book we talk about today in the conversation. We start by talking about the euro, just generally, what it is, how it works, how it functions. We talk about the European Central Bank, the ECB. We discuss inflation and price stability, the differences between the U.S. Federal Reserve and the ECB. The U.S. Federal Reserve is, or also known as the Fed, is the central bank in the United States. We also talk about how the euro came to be, some of the particulars around joining the EU and what that has to do with, the euro. We talk about some of the debates around ending the Fed. We talk about the Greek crisis and other crises that happened in the 2000s. The COVID-19 pandemic and how that impacted inflation worldwide, the future of the euro, and many other topics. I've been very curious about the euro and how it has been holding strong. I don't know if it's growing stronger or if it's just kind of staying stable, but it's very interesting as a, kind of, again, from a U.S. perspective, how it will kind of go back and forth with the dollar and the euro and how it holds a global standing. So it's very, very fascinating. John's a fun guy. He's brilliant and just real lively in the conversation, which I really, really enjoyed. As always, you can find this conversation and all other conversations at convergingdialogues.substack.com. I'm also on YouTube, so get over there, subscribe to the Substack, share with your friends. And now I bring you John Cochrane. I am here with John Cochrane. John, thanks so much for coming on the podcast. I'm greatly looking forward to talking to you.
Me too. This will be fun.
Yes, absolutely. So you and a few other folks have written a wonderful book. The book is called Crisis Cycle, Challenges, Evolution, and Future of the Euro. This is out through the always wonderful Princeton University Press. Very, very good. So we're going to talk all about it. Two things. Before we do, why don't you tell me about your, kind of potted biography, academically, professionally, and then tell me how the three of you, so it's you, and then it's Luis
Garicano.
And Klaus Mausch.
Mazuch.
Man, I totally messed up all of these names. Apologies. I will say, though, it is quite the international endeavor you guys did. I mean, from what I can tell, you guys are working different places, from different places. So that's really, really, really awesome. Tell us about yourself a little bit, and then how you three work together on the book.
Great. I am I was a professor of economics and finance at the University of Chicago for many years. Now I'm a senior fellow at the Hoover Institution here at Stanford. And I've done lots of work on money, inflation, stocks and bond prices, business cycles, and a whole bunch of other things. Being an economist is wonderful. You can do all sorts of fun things. Luis, I got to know him when he was at the University of Chicago. He was a professor there for a while. He then moved on to, he's at Europe now, LSE. He's been a member of parliament for Spain, so dipped into the waters of public service and learned a lot about European politics that way. Luis runs a wonderful blog called Silicon Continent. I should advertise my blog, The Grumpy Economist, but about all things Europe, Luis is just on fire. And Klaus worked at the European Central Bank for most his entire career. He was one of the top staff economist people. He was in charge of lots of parts of the Greek effort, so he really knows what's going on inside the ECB. And we've all been friends for years and years, and came around this project. I had been working on fiscal and monetary policy together. I have a book called The Fiscal Theory of the Price Level. Sorry, I got to pitch two books in
No, that's great. No, that's great. Yeah, that's great.
An academic book on how monetary and fiscal policy really are all the same thing. Came out just as our government printed up $5 trillion, handed it out, and caused the exact kind of inflation that my book said don't do. So, thank you, Joe Biden, for the book sales. And that kind of thought applied to Europe. That's how Luis and I got started, and we've both known Klaus forever, so got talking to him about the project. And of course, he was crucial because he understands the ECB and how it works. And then it was a great partnership because Klaus would say all sorts of things in big fancy ECB talk, and I would say, Klaus, I don't understand a word of that. So explain it to me slower. And then I ended up doing a lot of the explaining things slowly without acronyms, no three-letter word combinations, three-letter combinations, which produced the book about the euro, where it came from, and where it's going.
Yeah, it's nice. Was it one of those things where you would have conversations and then you would write it and then you'd say, okay, read this. Did I get this right? Yeah, looks good, sounds good. Or did you you wrote a chapter, someone else wrote a chapter? Three people is kind of a lot to juggle. How did you guys do it?
Yeah, we would each take the lead on one of the other chapters, and then the others would come in and tear it to shreds, and then somebody else would come and restore half the changes, and then we'd get on Zoom and yell at each other.
That's good.
But actually, it was much better than that. We're all three have separate things we're good at and bad at, and so it was a cumulative process more than anything else.
That's very nice. Yeah, I actually think, there's probably a lot of cons to it, right? But a lot of pros of writing, books with people, or if people do other types of art, music or films or things like that. It's nice having a collaborative thing.
I wish I worked together more often because your colleagues catch your mistakes.
Yes.
And, when somebody writes something and then, especially writing a book where it's big and then, one of my co-authors would go off, in chapter 12 on something, and I would say, "Hey, we did that in chapter 8." Keeping the repetition down to a manageable level, telling a story in a distinct way, understanding what your audience knows and doesn't know, just having people to check all that stuff, or getting things wrong. My first drafts had mistakes in them, and Luis and Klaus picked those up, so it was great.
Yeah, that's really, really nice. Yeah, I in my world the same. I'll write a report, and then I'll have colleagues say, "Can you read this?" And they'll be like, "Yeah, why did you say this?" I'm like, "I don't know why I said that. Let me take that out." So it is nice to have good collaboration. So so the euro. So as I was telling you about before we started, I have a lot of the listeners. They're here in the United States where I'm at, but they're a thoughtful bunch, and a lot of folks are internationally minded. So in the United States, I think people have a view or an idea of the euro. Whether it's accurate or inaccurate is to be determined. And then there's listeners on the podcast that live in the euro, so they use it, live in the EU, so they use the euro. And people that live in countries adjacent to it. I think it's nice to consider that. So, yeah, tell us what the euro is in terms of how it came to be, where it's at now, and where do you think it's headed? A lot of people have said many times that it's finished. The EU might not be together. What the euro is not stable anymore. Blah blah blah. So yeah, kind of just give us the kind of beginning, middle, not end, but kind of future of where the euro is.
Yeah. No, I did write a book about this. Short version. So we are all three fans of the euro as a general project. There's lots of people say it's a terrible idea to, can't have it. Sorry, we like the euro. For much the same reason that I like the dollar. The United States prospers by having all of our 50 states use a common currency. And when I drive to Nevada to buy gas at half price of what it costs in California, I don't have to exchange currency in order to do it. Now, it's true that might be a minor annoyance, and especially today, minus some credit card fees, you can take care of it. But a common standard of value, it seems like a very good idea for a place that wants to be open, that wants lots of trade between California and Nevada. That trade between California and Nevada is a good thing. We don't put up tariffs between states. We agree we're part of one country. So the same for Europe. Europe, although Europe's different in that the member states are still their own sovereign countries. They keep their own fiscal policies. They do a lot of stuff on their own. Nonetheless, they are, the size of American states. And so having a common currency is going to be much more efficient as part of the general vision that, this should be a giant free trade area. Of course, I think the whole world should be a giant free trade area, but that's not the question. At least within Europe, I think they recognize we're too small to each go it our own way. So a common currency is a great idea in our view. And the same reason that, we used to have every little city had its own weights and measures. Well, that's dumb. Why don't we all use the meter? So that's kind of my general vision is meter is pretty good for everyone. The U.S. goes its own way with feet and pounds and inches and so forth, but everyone else uses the meter. So, a standard of value, a common standard of value is generally a good thing. Now, we all sorts of arguments one way or the other about how useful it is for countries to have their own currency and so forth, which we can get into if we want, but we kind of think it was a good project. So it came to be. How did it come to be? In the 1990s, as part of the common market, the European Union integration said, hey, let's have a common currency. That ought to make it easier to have all this trade that we want between the various countries, financial integration, economies of scale, and so forth. So they put together a common currency. That's where it came to be. Then it's evolved in ways that we'll get going, but that was certainly the good idea that at the beginning, and now we have to design a common currency that's going to be shared by countries that still maintain a great deal of individual autonomy, although under a free trade agreement.
Yeah. So you have a European Central Bank, the ECB, as we'll call it from here on out. How does that? So in the United States, we have the Federal Reserve, but I guess it's sort of analogous to that ECB. But how does it work different from other central banks, and how does it interact with each country? And you said that each country has its own sovereign state, so it's they do their own fiscal policy. But there's 28 countries in the EU, so there's different countries that are going on. So yeah, how does it work from other central banks around the world? And here you could talk about lending, interest rates, asset purchases, et cetera. You can go wherever you want with it.
So it is different in many interesting ways. It's the same in some of the most important ways. So the ECB, like the U.S. Fed, its main tool of monetary policy is to set short-term interest rates by how much at the rate at which it lends to banks or takes money in from banks. And that sets the interest rate throughout the euro area in the same way that the Fed sets the interest rate throughout the United States or anyone using dollars. And it does so with roughly the same conceptual framework. They say they're only paying attention to inflation, but they're actually paying attention to unemployment as well. And we'll get into that. It's a little bit different in its operations. And I don't know how much we want to get into the weeds here of asset purchases and bank lending and so forth. It's a little bit different in its political structure, which is more and more important these days, in case you've been noticing a little bit of tumult between Trump and Powell. The ECB governor is appointed by the European Union. and the other governors are, I think they come from the individual countries for a fixed term, and there's not renewal. And the European Union is much less powerful than the U.S. federal government. So it's much more of a technocratic, independent agency that can go do its own thing, which is sort of how Europe in the current EU seems to like to work. We're much more democratic. We vote and really pay attention to congressional, Senate, and presidential elections. The European Union kind of trundles on and has less political. There's less political fuss for the moment about where the ECB goes, but that could change as well.
How does it the ECB, with the currency, with the euro, how does that try to navigate inflation? That's something that's come up a lot. You mentioned there's a chapter in the book about the pandemic, and we can talk about that more head on or specifically. But generally, how has it tried to manage inflation? I mean, again, there's many countries, Western, Eastern Europe, things like that. In Europe, and how does that again look different from maybe how the U.S. does it, or even how other countries, maybe in Asia or things like that, try to, Korea, Japan, things like that, try to manage inflation?
Yeah, for its central job of inflation. So the European Central Bank is set up very nicely with a mandate from the European Union that says pay attention to price stability, which the ECB, like the U.S. Fed, interpreted to mean 2% inflation on a forward-looking basis. Okay, we'll fight about that some other day, but they do it the same as we do. And then they fight it with conventional tools, fight it or try to stimulate it with the conventional tools of raising and lowering interest rates, just like the U.S. Fed. And also buying assets, which may or may not have worked, but that's something they started doing when interest rates hit zero. So that part is fairly conventional. Unlike like the U.S. And unlike some smaller countries, they don't explicitly pay a lot of attention to exchange rates, and they don't, for example, have an exchange rate peg. They're just manipulating interest rates to try and set inflation. So in that sense, it's the ECB is quite conventional. Now, like the US, does any of this work is kind of an open question, and that's not particular to Europe. Monetary policy is kind of interesting in that a mantra is repeated about how it works that does not correspond to any of the equations of any economic model that anyone has written down and published for about 30 years. But that's another story for another day. They raise interest rates when they think inflation's too high and lower interest rates when they think inflation's too low. And when it gets lower still than that, they start buying bonds. And that's how the ECB works. That's how the Fed works. All the differences, which I think we'll get to, come in other areas.
So the big thing that you mentioned in the book is this aspect of price stability. This is this price stability mandate. Like that's a big thing here. As an independent central bank, essentially. Talk about that. Tell us about the specifics of this. Is it just a kind of aspirational thing, or what are the kind of sort of nuts and bolts of how they try to maintain price stability? I mean, maybe interest rates come here or whatever, but what's the way in which they do that? Well,
but raising and lowering interest rates is the main one, and buying and selling assets. That's what central banks are allowed to do. It's kind of interesting that, if you want to cause inflation, the easiest way to do it is to print money and hand it out. That's what we did in 2021. Central banks aren't allowed to do that. Fed isn't allowed to do that. ECB isn't allowed to do that. And if you want to reduce inflation, the easiest way is to go grab people's money and burn it. Now, ECB is not allowed to do that. Fed's not allowed to do that. They have a limited mandate, but that's right. In a democracy, you can't have independent technocrats taxing and spending. That is reserved for our beloved politicians. That's how democracies work. So the ECB is the same as Fed. Their tool is raising and lowering interest rates, buying and selling assets, and they are limited to those tools for the reasons that those are the only things you can really be allowed to do and stay independent. And that's the interesting thing about the mandate. So you cannot let technocrats loose. We don't say, here's an independent technocrat who's going to run taxing and spending for 7 years and nobody can tell her or him what to do. That's not how we run things, right? But we do that with interest rates. So central banks have this limited mandate. In the ECB's case, it is price stability. What you shall worry about is price stability and only price stability. When you see a mandate, that doesn't mean just what you should pay attention to. It says there's all sorts of things that you shouldn't be paying attention to, namely anything but price stability. So when the ECB decides it wants to pay attention to something else, you'll notice how they always have a torturous language to defend it under price stability or monetary policy transmission. Well, that's the ECB's mandate. The U.S. Fed's mandate includes price stability and employment, so they are more legally allowed to say, well, we're going to, goose the economy. So what about inflation? Because we were told to do that. The ECB is not supposed to do that. They're supposed to just look at price stability.
But they do look at employment as well. I mean, maybe
sure.
unofficially, right? Unofficially.
Well, there's a legitimate reason for it. If you're in a time of high unemployment, it is certainly likely that you're going to, historically, those have been times when you're going to see deflation, and times of very low unemployment are associated with inflation. So you can say, I look to unemployment because of inflation. That's interesting so the mandate is from the 1990s, and there was an academic consensus that the best way to stabilize employment is just to stabilize prices. Milton Friedman had this old analogy of the shower. You turn the hot water on, and then it gets too hot, and then you turn it on, and it gets too cold, and so forth. That avoiding the cycles of inflation and disinflation of the 1970s, which caused huge spikes in unemployment, if you could just avoid the spikes of inflation, then you wouldn't have to be constantly fighting it with high unemployment. So just pay attention to inflation, and the unemployment will take care of itself to the extent that the central bank can do so. I think that's right, and that is that's the sense in which the mandate was a good thing macroeconomically.
Maybe you mentioned it before and I missed it, but so I mean, it just sounds like the Fed in the U.S. and the ECB in the EU are almost very similar. There's more of you said technocratic kind of aspect to it. It's a little bit more democratic, so to speak, here in the U.S. I mean, but where is the daylight between the two? I mean, it sounds very similar.
The big difference.
Yeah, what's the difference?
Why did we write a book about the euro? And I should have gotten much earlier the central point of this book.
That's okay. You're good.
So here's the way in which the ECB and the euro are set up very differently from the U.S. Fed. The U.S. Fed is a central bank for one government, the U.S. government. The ECB is a central bank for a whole bunch of different ones. So there's this problem. If you and me and 22 of our best buddies go out to dinner, and the waitress comes around and says, "What wine would you like?" There's a big incentive to say, "I'll have that $400 bottle of Chateau Bonilla,
that's right, yeah.
1957."
That's right.
Because everyone else is paying the bill, right? So more prosaically, if we have a currency union, but we do not have fiscal union, there's nothing wrong with that. Lots of people will say you can't have currency union without fiscal union. Absolutely wrong. You can have currency union without fiscal union all you want. But if you do that, you have to understand that countries must default just like companies. People say, Greece can't default, it has to exit the euro. No, it doesn't. General Motors can default. It doesn't have to exit the dollar zone and go use Canadian dollars or something of the sort, or invent GM dollars. It just goes bankrupt. So countries in a currency union without fiscal union, currencies have to be able to go bankrupt. Well, nobody was really willing to say this out loud when the euro was founded. And there's a big disincentive problem, like the bottle of wine story. There's a big incentive to run up a whole bunch of debt and, buy everybody, free Porsches or whatever, and then say, oh, crisis, instability, contagion, ECB, come print money and bail us out. And everybody understood that was going to be a problem when the euro was set up. So that's the central, what we call monetary fiscal interaction. That's a big problem for a currency union. It's already a problem for the U.S., right? Right now, the big fight between Trump and Powell has boiled down to, I want you to lower interest rates because that lowers interest costs on the debt. We want basically the Fed to bail out the Treasury from our increasing inability to sell debt. We're looking a lot more like Greece. Okay, there's an even worse problem when you got 22 people on the fiscal side of it. So that was understood. And the euro, this is sort of the first part of our book, the euro was set up with, for the 1990s, a really clear-eyed understanding that this was going to be a problem, almost. So what did they do about this problem? They said, first of all, the European Central Bank will be politically independent, and it will have a mandate to only worry about price stability. That's important. And it won't buy sovereign debts. Now, that's kind of fun, because in the U.S., the Fed buys treasuries. In fact, it's really supposed to only buy treasuries. That it started buying mortgage-backed securities is a little bit of a scandal in the U.S. But in the U.S., it's only supposed to buy treasuries. Not all central banks have that. Many central banks have a prohibition on buying their own government's debt, precisely to stop them from financing deficits. But the ECB, it wasn't really in law, but it was pretty clear you should not be buying sovereign debts. It's kind of interesting. The ECB is set up completely differently. We'll get into this on how it creates euros, but it was not by buying sovereign debts. And then we had debt and deficit limits. So first of all, the ECB won't buy your sovereign debts, and second, we won't say that you'll go bankrupt, but we'll try to make sure you won't get in trouble in the first place by you're supposed to follow debt and deficit limits just in case. Now, what they did not do, the central failure, was say out loud, by the way, countries now, this is risky. Country sovereign debt is like companies. We'll let it go bankrupt. We will not bail out ex post. They didn't quite want to say that. Because sort of like, how hard do you want to negotiate the prenup the night before the wedding? Honey, we need some strict rules here about who goes shopping on whose credit card. It's not going to be a fun wedding night if you if that's what you're talking about the whole time. And of course, we're all going to behave. No one's going to bust these debt and deficit limits. And in the 1990s, who would have ever thought there'd be sovereign debt crises or financial crises? You don't write rules for every possible contingency. But then this is, the story of the book is this is what came back to bite. That the very problem that everyone was worried about, those limits proved to be not enough. And there's a sequence of crises and didn't reform the system. And our book is about the sequence of crises and how we didn't reform the system. And we're stuck back with that basic problem that it all started with.
Yeah, so the triple lock, right? No buying or no sovereign debts, no limits, limits on the debt and deficit, and no bailouts. So this is the
sorry, I forgot to mention there was a no bailout. Not only would the ECB not buy it, but don't count on fiscal transfers from other countries. We will not bail out each other's sovereign debts. You are supposed to repay your sovereign debts. Thanks for mentioning that. That was an important part of the original architecture.
Yeah, so that happens in the U.S. We do those things. We have bailouts. We don't have a debt limit. So I don't think, right? We buy out.
We bail out banks. Whether we're going to bail out states is a very interesting question in the U.S. Most states have balanced budget limits, which are we sort of pay attention to, except for pensions. There's these huge pension obligations. So what happens when Illinois and California go bankrupt is a really interesting question.
Yeah, would the Fed have to say like, hey, listen, it's one of the states, we got to bail them out? Like, do you think that, it's never happened, right? So do you think that would happen or?
Well, in some sense, it's already happened. In 2020, in the COVID pandemic, states were having trouble selling new municipal bonds. And the Fed bought new municipal bonds at issue directly from the states and local governments, something it doesn't even do for federal debt. We pretend that banks buy it and then the Fed buys it from the banks. So, we just did for state and local governments what the ECB did for Greece and Italy. So no one's pure. Now, that's not, we let them roll over debt at lower interest rates. The Fed never really bails out. The Fed lends money to the Treasury, who does the actual bailout. So I just want to be accurate about what the Fed does. But the Fed lends money at nice low interest rates, and the Treasury takes the credit risk. So in the U.S., it will be a Treasury bailout. The taxpayers will end up paying. But the good question, will we let a state go bankrupt? In 1830, we did. A bunch of states, the big infrastructure project at the time was canals. A bunch of states put a huge amount of money into building canals. The railroad was invented. and there were state bankruptcies, and the federal government did not bail out the states then. But 1830 was a long time ago.
Yes, it's almost 100 years ago, or 200 years ago. Excuse me. Yeah, I guess the one thing here is we have states. As you're mentioning, there's 28 countries in the EU. How was it in the beginning where they managed to say, okay, we're not gonna have separate currencies? I mean, some states do, I guess, right? Finland does, or excuse me, Denmark does, Iceland does, Sweden does. There's a handful that have the krona or whatever.
The Eurozone and the European Union are distinct, and the European Union is larger, including many countries that maintain their own currencies.
That's right.
Including the ones you mentioned. Yes.
Mm-hmm. So yeah, the folks that use the euro, I mean, yeah, how did you get 20 plus countries to just say, yeah, we're not going to have our own currency. We're just going to use all the same one. I mean, was it just like, let's try this and it should be fine, or what? I mean,
well, they saw the advantages of it. Europe aspires to be a larger, economically more effective place. And 22 small countries all going at their own way, they realized is not going to be very useful here. It's not going to be very productive. So having a common currency was important. It's also part of the political project. There were some kind of nasty wars in Europe in the last century, and they don't want to do that again.
Yeah.
So the idea of political unification and the architects of the euro. There's always, you get a bunch of economists together and they'll all argue about who should have their own currency and so forth. But really, the bottom line was this is part of our political unification project. So that's why we're doing it. So that was a lot of the motivation. I should say, as a big fan of European integration, the results have not been as much as I had hoped. I'm a free trade economist, so Europe, when it starts having free trade, should be exploding. Yet European growth has completely stalled. Europe is falling farther and farther behind the U.S. despite the euro and the European Union. Now, it turns out their trade isn't so free in Europe. My colleague Luis Garicano has some calculations. There's as much as like 100% effective tariffs between countries because of regulations, and Europe is regulating itself to death. So it's really sad that Europe is not exploding at the kind of growth that you would think the economies of scale of a market the size of the United States would give it. But that's not a euro story. That's a regulation story.
Let me ask something here. It just came to mind. You'll see some folks or some countries that will enter the EU and then take the euro. That's happened obviously since the 90s. There's a handful of countries that want to enter the EU, and they have their whatever application or whatever, the process it's a whole thing. I mean, wouldn't that be helpful, or would that be more harmful? I mean, I think I don't have all the lists in front of me. I know Ukraine is one of them, obviously.
Yeah.
Turkey is a big one. They've been wanting to enter the EU for a long time. And a lot of the Eastern Bloc, Eastern European, I think Moldova and, probably Serbia and Bosnia. So, yeah, I mean, what is the kind of like piece of it where it's saying, we're cool with what we got. We don't want any more countries. This is just going to make this a bigger problem and all these things. I mean, what's the kind of like, the e-brake here on some of these things?
Well, it's joining the EU versus joining the euro. So far, no one's joined the EU without joining the EU, but you could do it. Joining the EU is, they're very fussy about who they let into the club. And I'd love to see Ukraine part of the EU. But, also from a country's point of view, then Brussels is running your regulations. And, have you labeled your prosciutto properly or not is, this whole regulatory onslaught hits you when you join the EU. But, Ukraine looks at that and says, well, that's a whole lot better than joining with Russia. So we're in. Now, joining the euro is interesting. If a currency were good enough, people would just join it on their own. They wouldn't need some big international agreement to join a country. Anybody can use the meter. You just say, we use the meter. And lots of Latin America use the dollar.
The dollar, yeah. And Ecuador, El Salvador,
they just say, well, they did that on their own. The ones that do it
that's right.
officially, and most of Latin America does it unofficially. The dollar is basically the currency in Argentina. We just have to get around to saying it. So, you're now, unfortunately, formally joining the Eurozone means there's a whole lot of bureaucracy and rules and stuff associated with that. But countries could just say the euro is legal tender in this country. Now then, the problem, of course, is you want interbank payments to work, and the whole Target 2 mess and the other parts of joining the euro. So it's a little harder than I've said, but I would encourage those countries just use the euro. Now, the problem is, if the euro were set up as a beautiful, wonderful currency, the way we would like it to be, it would be as more attractive even than the US dollar. If it were just, this is a stable standard of prices, the meter is in Paris under a box, and the euro is in Frankfurt, and come use it world, it'll be fun. But unfortunately, you're tied into this whole monetary fiscal mess, and you join the euro, you're going to be in part of the bailouts of the sovereign debt that are coming. So I think that's some of the reluctance of countries to join what should be, which should be a great project. It should be like joining the meter zone, a completely no-brainer. But you're signed up now for all the fiscal mess that I think we're getting to.
Let me ask, I'm going to merge two questions here before we go to some of the specific crises. A lot of people want to end the Fed. You don't have to give me your public opinion on that necessarily per se. They want to end the Fed here in the United States. I think a lot of people have different reasons for that, and sometimes people don't like the way it's set up. They don't like the structure or the hierarchy. So you can say whatever you want about that or opine about that. But second to that is the hierarchy of the ECB. So you mentioned in there the NCBs, the ESCBs, and so what's the kind of hierarchy there and decision trees for some of their monetary policies that they're influenced in?
Yeah, I'm sympathetic to the motivation by the Fed crowd, but there is a natural function of government, which is to proclaim a common standard of value, to provide a currency that we all use. Now, I'm as guilty of anyone else of late at night after too many drinks speculating about libertarian nirvana, where we discuss, shouldn't we privatize pilots' licenses? And shouldn't we have some independent standard of value that isn't determined by governments, maybe Bitcoin or Scottish free banking or gold standard? Yeah, great, guys. But we got a bigger mess on our hands, so let's worry about the things that are important. A government-determined standard of value is a pretty good thing and sort of on the list of public goods that should be provided competently. It's up there. Now, that doesn't necessarily, we need the Fed as currently constituted, and the Fed is also
but what would be the replacement for it, though? I mean, you have 50 states and 8 territories or whatever, and then other countries use the dollar. It's like, how are you going to manage and navigate a country of 350 million people with all those states, all the property, all the things? Like, you can't just have like the old days where gold was there, or the old days where you just had these, 2 or 3 banks in New York that were, whatever. Like, what's the alternative? I don't know what the alternative would be.
Well, I think does all of that stuff need managing, or is it better left to its own devices? Is a genuinely good question.
Sure.
But there is, even in the Constitution, I think it was Congress that has the right to, set coinage and, what's the value of things. So that is kind of a core government function. And in today's economy, central banks we've kind of evolved to that. So let's talk about how to fix them, not how to completely replace them. Well, we can come on another podcast for alternative standards of value and why central banks are a good idea.
For the ECB, sorry, go ahead.
The Fed has said there are regional Feds. It was set up in 1913 as a very consultative institution. It's a formally private, and it has these regional Feds. And if you read the Fed governors, they're supposed to be bringing information in on monetary policy. It's interesting. The ECB is an evolution of the national central banks, which still exist. It really is not the ECB. It's the Euro system comprising the ECB and the national central banks. So, for example, when the ECB buys Italian debt, it's still the Italian central bank that's buying the Italian debt with newly printed euros.
I see. So that's sort of how the hierarchy goes, is that each country has its own kind of, bank, but then they're going to the ECB and then they're coordinating together.
Yeah, the ECB sets the big policy decisions, like what's the interest rate, but then a lot of the execution is national central banks, which leads to a lot of so when the ECB buys Italian debt, the Italian Treasury gets the benefit. So that's one example of where this structure matters. So suppose Italian debt's trading at 5% or a spread over the German debt. When the ECB buys the Italian debt, it's the Italian central bank that buys that Italian debt, but basically borrowing money from the ECB to do it. So the result is that the Italian central bank rebates the profits back to the Italian Treasury. So basically what's happened is the Italian Treasury gets to borrow at the ECB's overnight rate rather than pay the 5% that bond markets require. So that's one little example of how this national central bank system still impacts things. Another one is this whole Target 2 question, which I don't want to get too deep in, but what should happen if Italy imports Porsches, then Italian bonds should flow back to Germany in the other direction. What ends up happening is that stuff all ends up going through the central banks. So rather than Italian capital flowing to Germany to finance a trade deficit, instead a perpetual loan from the German bank to the ECB to the Italian bank ends up financing it. So there's this huge trillions of euros of Target 2 balances that have built up through that structure. So there's plenty. We should get back to the big deals, but there's kind of some small deal problems that need to be fixed within the ECB.
Yeah, the Target 2 thing does sound complicated. Sounds a bit messy.
Let me get a little to the big deal issue before we run out of time. So what's the big theme of the book? We start with this problem everybody recognizes, that we're going to have a common currency, independent fiscal policies. We don't want y'all borrowing too much and then coming to us for a bailout, either a fiscal bailout, there's the third of the triple lock, or the ECB printing money. And so we set up debt and deficit rules, an independent central bank that only has a price mandate, not even a financial stability mandate. And we hope that's going to work. We don't quite say countries will go bankrupt, and we don't put in a bankruptcy resolution mechanism. But, 1990, at least we thought about the issue, which nobody was thinking about in 1990. Then a bunch of crises come. First of all, France and Germany blow through the debt and deficit rules. And, we can't do anything about that. Why not? Because it is France, So that kind of, if France and Germany are doing it, why should Italy and Greece bother with it? Then we get a financial crisis, and the ECB starts buying bonds. It starts bailing out banks and buying bonds. Why? Well, like here, the U.S. Fed, it would have been nice to have a good system, but when the crisis comes, the central banker is going to bail out. That's the way it happens. But normally you reform after the fact. And, to their credit, they tried with this Dodd-Frank Act in the U.S. and similar stuff in Europe. Didn't work, but at least to their credit, they said, hey, there's a problem here. We'll do something about it. Well, more recent crises, nobody is ever saying there was a problem here. It's just, we threw money at it. And then comes the European sovereign debt crisis, where Greece was unable to roll over its debts. And so this was the big one that kind of breached. This was the problem that we had all warned about, and here we are.
Can you pause here and tell us? I mean, you don't have to go through the blow by blow, but what happened in Greece? I mean, we have some time away from it now, 15 years. How did it get there? What happened, and how did people try to fix it?
So the basics, it might remind you of the U.S. too. Greece joined the European Union and the Eurozone. When you use a common currency, you are pre-committing that if you get into trouble, you cannot devalue the drachma and inflate away your debt once again. That's what having a common currency means. It means we are pre-committed. We pay back this debt or we default on it. And exiting the euro is a default because our debts are now promised to be repaid in euros. So you cannot inflate away your debt anymore. Well, your bond markets look at this and say, Greece is pre-committed. They have tied themselves to the Odyssean mast. They cannot. All the people who love their own currency say, you can just default, you can just devalue rather than default in a crisis. Well, pre-committing that you're not going to devalue in a crisis means that you're bondholders are going to get paid back. And bondholders say, great, we'll lend you money now because we know you got to pay it back. Or at least it's going to be really costly for you to default. So interest rates plummeted and Greece got access to capital, which is exactly how it's supposed to work. This is wonderful. Unfortunately, like the U.S., faced with low interest rates from our Asian investors, and Greece did not use the money to build bridges and to get their economy going. They went on a consumption binge, and then they cooked the books. And when the Greek debt crisis came out, what really happened is people figured out there's way more debt, and there's no way Greece could repay it, and so the bondholders refused to roll over the debt. And so every debt crisis is a rollover crisis. Interest rates spiked. And now if you have a lot of debt at low interest rates, you can finance it. If interest rates go up, you can't finance it. So you're kind of stuck there. There's this run that happens. So there's a crisis on Greek debt. And now what happens? Well, Greece didn't get bailed out. Greece's creditors got bailed out. What ended up, the ECB faced this situation. And what do we have? There's no fiscal bailouts allowed. There's no mechanism for default. There's no crisis resolution mechanism. There's no IMF that can come, that's ready to come. In a bankruptcy, you don't just say, we're not paying. There's a whole procedure, who gets what, debtor in possession financing, reorganization, a plan. We'll give you some extra money to get through it. But that mechanism wasn't put in because we couldn't say that sovereigns might default. So that was one of the missing pieces. So the ECB eventually felt, well, we got to jump in. And what got bailed out was German and French banks. German and French banks had lent a lot of money to Greece. And boy, would it have been embarrassing right after the financial crisis to say out loud, we just did this again. We lent a lot of money to Greece. And one of the other problems of the euro was since we couldn't say out loud that sovereigns might default, bank regulations treat sovereign debt as risk-free. So there's a big incentive for banks to load up on high-yield sovereign debt. And in all their regulations, they get to say, hey, we don't need any capital for this because it's risk-free. Sovereigns couldn't possibly default. So now you got a hostage. If Greece defaults on their debts, it's not just you and me who lose money. It's banks that go under, French and German banks that go under. So what got bailed out was the French and German banks, the ECB banks that bought up.
This is why Angela Merkel was so involved during this period, right? I mean, she was part of the German banks were there, and she was a big leader within the EU. But I mean, it had an impact for the German banks, no?
Oh, absolutely, because German banks were sitting on holding a lot of Greek debt. And heaven forbid the German and French banks go under once again, right after this horse is, right out the barn door. So, they talk about contagion and instability and so forth. But, once again, people had lent too much money because the regulators let them lend too much money, a problem that is still not solved. And the ECB, now to its credit, when the crisis comes and the badly designed system falls apart, you're the only one in town. You got to do what you got to do. And, Draghi famously say, whatever it takes, and got through this one. So our criticism is not that they reached all the understanding they built out. It's just after the fact, you need to set up a better system, which actually a better system did sort of evolve after Greece. What you need when a country gets in trouble, first of all, you need to tell banks, this is risky debt, and we're going to treat it like risky debt. You need capital. You need it diversified. They still haven't gotten around to doing that. European banks still get to treat sovereign debt as risk-free. But you need some mechanism. You need some sort of bankruptcy mechanism, and that did evolve. The ECB help was under conditionality, designed by my friend and co-author Klaus. And that's what should happen. You get help. We will help you tide you over this debt crisis. But in the meantime, here's how you're going to reform your spending and your taxes and stop throwing money down rat holes. And we'll get a plan where your debt becomes sustainable. So that's kind of what could have evolved after Greece. But that lovely experiment kind of fell apart. And now, then crisis after crisis, I won't tell you the whole story of the whole book. But where we are now is the ECB. Banks are still stuffed with sovereign debt, still treated as risk-free. So if any sovereign defaults, the whole banking system goes under. The ECB holds immense amounts of sovereign debt, and under its new acronym-laden buying proposal. It can buy whatever it wants. Everybody expects that, spreads will not rise. That if Italian spreads start to rise, the ECB will say fragmentation, dysfunction, and hold down spreads. And so Italy now and France has very little incentive to reform their affairs because they don't feel the heat from bond markets. Bond markets would on their own be saying, we're not lending you money at these low rates, but the ECB is holding down the spreads. So we're kind of stuck back where we started from.
Two final questions here. A big topic, obviously, but just give me the highlights. The pandemic, it hit everybody. You can pick on Joe Biden, what we did here. What did we spend? $5-6 trillion. You can tell us here in the U.S. since you mentioned it, why that was so terrible. And then how did the ECB manage the pandemic and all the things? I mean, there was a lot of similarity, but maybe there were some differences. Like what went wrong and what would have maybe been a better way to have handled, such a tough situation?
Yeah, so the U.S. and Europe and the U.K. and many other countries reacted to the pandemic with a river of money. In the U.S., $5 trillion right off the bat and another $5 trillion afterwards. So one of the biggest mistakes in the U.S. was not so much what we did in the pandemic, but that afterwards we didn't say, great, we just borrowed $5 trillion, we'll start paying it back, the pandemic's over. No. We the drunken sailors stayed at the bar long after closing hours, which I think was a lot of the problem. Now, in retrospect, we clearly had to do something. So I do not think we should have run a balanced budget. You can't let every business go bankrupt. You can't let people die in the gutters. But they threw around money like it was going out of style. In part because at the time, modern monetary theory and secular stagnation and government debt doesn't matter that was all the rage. So nobody worried about paying back the debt. So I think that the pandemic spending, some of it was necessary, but it went way overboard. And it was not accompanied by the usual, here's how we pay it back. It's very standard in a war or a crisis to borrow a lot of money, spend it kind of indiscriminately, but then afterwards you start paying it back. And that doesn't cause inflation. So way too much spending, no plan to pay it back, I think was key why we got a lot of inflation. Now, was that a mistake or not? Our central banks have not really come up and said, you know what, our targets were 2%. We hit 10. Something went drastically wrong here. What are we going to do differently? You don't hear that from the U.S. Fed. You certainly don't hear that from the ECB. It's all, some shock or hit, and who knows what happened, and so forth. And there's a school of thought that says this is the right thing to do. We're going to pay $5 trillion of necessary spending. Do we want to raise taxes to spend it? No. Do we want to raise future taxes? No. Well, it's got to come out of the pockets of bondholders. So we'll just inflate away the debt to $5 million, and that's like a partial default, and that's how we'll pay for COVID. There's been big inflation after every single war in the U.S., Revolutionary War, Civil War, World War I, World War II, and we paid a lot of the war from inflating away debt. So there's a school of thought that says that was the right thing to do, but then, boy, I wish Washington would be honest about it and say, well, we faced a crisis, and we need to pay $5 trillion. We didn't want to raise your taxes, so we defaulted on $5 trillion worth of debt, worth of inflation. Elect us again next time. I think that they're not saying that as a consensus, that this went wrong in fundamental ways, that they way overdid it. Is there a plan in the next crisis to spend a little more efficiently, to borrow in ways that can credibly promise repayment so it won't cause inflation? Let's reform our long-term entitlements so that we have borrowing capacity. I don't see that plan. So here we are again.
So tell us about the future. The goal and vision of the euro was to have, you say, a stable common currency, facilitate European trade markets, finance, and economic integration through a central bank. After all these crises and the challenges and everything, why are you and you can speak for your other two co-authors, why do you guys still think that the euro is the way, and how do you think it could be much better in the future?
Well, going back to national currencies that are devalued and inflated every time you have a crisis, I lived in Italy in the 1970s, and I used to think economic crisis was just how you say economy in Italian. Every day is a crisis. And so devaluing the lira and inflating the drachma every time you ran into trouble was not a great solution. And small countries with big trade barriers is not a great solution. So, Europe needs to be a united, large, free market, efficient area if it wants to prosper economically. I don't think there's an alternative. One possibility is we're wrong. So the current structure of the euro is that the ECB is, going to bail out anybody's sovereign debts if they get into problems, and rivers of money will flow. We think that's going to end badly, as it is going to end badly in the U.S. That first bout of inflation will be repeated in the next crisis until the point where it just gets out of control, where the ECB cannot buy sovereign debts and keep interest rates down. Look to Latin America to see what happens when fiscal policy gets out of control and central banks are determined that nobody ever goes bankrupt. You get waves of really big inflation, and that would tear up the euro apart. And Germans will be sick of paying for everybody else, and the Greeks really suffered. And if we try to say you have to reform in order to get some money, they're going to say no. That would be terrible to have it fall apart. So we would prefer reform, and reform is certainly possible. Number one, get the hostages out of the way. So this crazy system where banks are loaded up with sovereign debt risk-free in their own country. Absolutely not. Sovereign debt has to be treated as risky debt, just like corporate debt. And the financial system has to be able to withstand sovereign default. Number two, a mechanism that you can handle sovereign default in a fairly risk-free way. And number three, get the ECB out of the business of holding down spreads and essentially bankrolling sovereign debts. And then this, if we can reform this institution, it could go on to be the great thing it was supposed to be. And Europe wants to replace the dollar. The new thing is, the dollar's, who knows how long that's going to last? We want to be the international currency. Well, only so long as people have faith that the currency that they are buying into is not going to be devalued next time that there's a sovereign default problem.
It's a lot of unknowns. It's a lot of uncertainty. But we'll have to see. We'll have to see how it goes.
It's not that bad. So economics. What you got to remember about economics, especially central banking, everyone wants to make it complicated. Fragmentation, liquidity injection, contagion, blah blah blah. All of that is nonsense. It works the way your grandmother said. Just your grandmother was right about finances. Pay your debts back. Don't spend too much money. Low marginal tax rates with not a lot of deductions and exclusions. Don't spend like a drunken sailor. I'm talking to you, France. 55% of GDP. You got to be kidding. Deregulation is killing European economic growth. Internal barriers to trade, protecting domestic industries are killing the whole integration that was part of the European Union. Your grandmother said, clean up the sock drawer, clean up the underwear drawer, clean up the garage. Europe needs to do that. It's not that hard.
No, that's fair.
Conceptually.
No, that's fair. And that's what's even worse, though. It's not that hard and keep making the same mistakes. John, this was so much fun. I love talking about this stuff, understanding things that aren't in my wheelhouse, and you explain it very, very well. The book's great. So big thanks for coming on. I greatly appreciate it.
Thank you. This has been great fun.